Welcome to the second installation of our Blackwell Global educational series. In today's tutorial, let's look at the trade jargons that are commonly mentioned in the Forex market. Forex is quoted in the base currency and the quote currency. The base currency is always in the front, and the quote currency is always at the back. When the Euro USD is quoted at 1.38 cents, it means that 1 euro is equal to 1.38 USD. In Forex, we can make two types of orders, the long order and the short order. For example, when we buy a long 1 unit of Euro USD, we are buying 1 euro at 1.38 USD. Likewise, when we sell a short 1 unit of the Euro USD, we are selling 1 euro to receive 1.38 USD. This means that we can gain from the market going up as well as the market going down. We would also need to know how big an order we want to put in. The term of measurement in Forex is called a lot. One lot contract is equivalent to $100,000 in the base currency. For example, at 1.38, one lot of euro means you will need to hold 100,000 euros, and to do that, you need to have 138,000 US dollars. The contract sizing can go down to a mini lot, which is 0.1 of a standard contract and 10,000 of the base currency. A micro lot is 0.01 of a standard contract, and that means 1,000 of the base currency. The minimum trade size for Blackwell Trader is 0.01 lots, and this will give you more flexibility in your order sizing. Simply put, if you want to hold 15,000 of a specific currency, you will open a 0.15 lot order. Moving on to the next concept. What is a pip? A pip is a unit of measurement expressing a change in value of a currency pair. It is usually the fourth decimal place for most currency pairs and the second decimal place for the Japanese yen currency pair. For example, the Euro USD pair is quoted at 1.34520, and a few seconds later, the currency pair is quoted at 1.34530. This shows an increase of 1 pip. For the yen pair, a move from 103.00 to 103.10 would be an increase of 10 pips because we are looking at the second decimal place. One thing to note, this unit of measurement is only useful if value is assigned to it. So, how do we calculate value per pip in USD? This is dependent on contract sizing. Back to the previous example, Euro USD is quoted at 1.34520 and moves up to 1.34530. Assuming that we open a 1 standard lot long Euro USD, we would be using 134,520 US dollars to buy or hold 100,000 euros. After the currency pair appreciates to 1.34530, which is 1 pip, 100,000 euros will then give us 134,530 USD. This would mean you would have made a profit of 10 US dollars. The value per pip is thus 10 US dollars. Knowing pip value is useful as you know how much you stand to lose or gain per pip depending on the size of your order. This influences your stop losses and take profits and helps you make decisions whether to buy or sell. You don't necessarily have to calculate the pip value manually. At the Blackwell Trader website, there is a Pip Value Calculator. This is a very useful and hassle-free feature for you to calculate the pip value. All you have to do is to enter the value and options in the respective fields, click Calculate, and the results will be shown. At Blackwell Global, we do not charge commission on your trade. The only transaction cost incurred will be the spread. Now, what is a spread? Spread is the cost for entering or exiting your positions and is represented by the difference between the bid and ask price. Looking at the Euro USD currency pair as an example, the bid price is 1.3241 and the ask price is 1.3243. This gives us a spread of 2 pips. What it means is, if you open a long order, you are buying at the bid price. When you close this order, the order will be closed at the ask price. The transaction cost will be 2 pips, taken from the difference between the bid price and the ask price. It's vice versa for sell order. Let's relate this into what we have learnt. If you open a 1 lot order of Euro USD, The transaction cost for dealing with 100,000 euros is a mere 20 US dollars. The low transaction cost is the reason why people are attracted to Forex, which is very unlike the stock market where there is a much higher cost incurred. Now let's look at the different kinds of orders that Blackwell Global offers in the platforms. The first one is a market order, which is executed immediately through the MT4 platform and gives you the best available price in the market at that time. With Blackwell Global's straight-through processing model, you will be given direct access to the interbank market. This will ensure that you get market depth and the best available price at that time. The other is a pending order, an order that will only trigger when it hits the price which you have placed. There are basically 4 types of pending orders. Buy stop, for when you want to buy above the market price. You can set the order to trigger when the price reaches above the current market price. Buy limit, for when you want to buy below the market price. Sell limit, for when you want to sell above the market price. And the sell stop, for when you want to sell below the market price. Basically, with the pending order, you do not have to stare at the screen all the time to execute your desired order. You can set a predetermined level to do so. Branching out from that are the stop loss and take profit orders. These are also types of pending orders to take you out of the market when the market reaches a certain price. Stop loss takes you out of the market to control your losses, and the take profit takes you out to keep the profits. Using the Blackwell Trader platform, you can place a stop loss as tight as 1 pip from the market price. This gives you increased flexibility for you to manage your risk, unlike other platforms. And with this, we end the tutorial on Forex Jargons. Do keep a lookout on our YouTube channel for new Forex tutorials. To find out more about Blackwell Global, please visit us here.